Everybody, we are live. Today we're going to be talking about financing for engineers. This is kind of a special course we put together just to try to help engineers or people who work in the energy field understand some of the ways to get things financed. It could be loans, bonds, leases, capital leases, operating leases, performance contracting. All of those topics we're going to cover in general today. But again, it's just primarily trying to help more projects get financed and so they can actually get implemented. Financing is a huge problem with many, many types of projects, especially in this economy. So knowing how to get these things financed is just absolutely critical. So we're going to talk about a lot of the mechanisms to do that today. There are so many government programs we won't go into so much on the details. Grants and different opportunities. We'll talk generally about them, but there's new programs, especially for the government customers out there, that are excellent also that can help you with financing. But this is primarily about the mechanics of getting something financed from a commercial standpoint, getting a loan, bond, lease, how the cash flows will look, et cetera, what are the characteristics and what are the characteristics of projects. So this seminar probably lasts about an hour, and then we'll take Q&A, and glad to have everybody here. So let's get into financing for engineers. Many of you know this already, so we always go through this at the beginning of who I am. Where do we come from with this perspective is basically all of these different companies working directly with them or with their employees or even sometimes their clients. But all of these customers have taken courses from us, and it's a pleasure to work with them. A lot of the information we get, we actually learn from our clients. So that's a lot of fun. Enough about that. So we'll move on to the next thing we're really going to be talking about is money today. Money, it's all about money, and money is so important, especially in today's time. Agenda. So I'm going to go through a quick orientation to the problem, why this is relevant, what the opportunities are, and then we'll talk into some of the characteristics that favor financial arrangements, which project characteristics, which company characteristics favor particular types of financial arrangements. And these are kind of general statements, actually, that we developed when I was doing my dissertation. So that's that, and then we will get into specifics on basic financial arrangements, what the cash flows look like, what is an operating lease, that kind of thing. What does it look like? How is it best applied, et cetera. And then we'll take Q&A. Okay, so background, energy management projects are generally, especially in today's times, are generally good investments. They generally reduce costs. They generally have a pretty high rate of return, maybe 20 to 50 to 100% return on investment. That means anywhere from a 1 to 5 year payback. They generally have very low risk, lower risk than a lot of marketing projects or other projects that are out there. And energy management projects even have been shown to improve stock price. I'll show that in the next slide. But typically they also improve the quality, the productivity of the people that are working there, quality of the product in a manufacturing environment. And generally with energy management projects, you actually get improvements in assets that will have impacts on the rest of your facility. So if you improve the lighting, that's it's an upgrade to your building asset. That's also going to help your people be more productive, et cetera. And generally these things do have lower risk than other types of investments. The key thing about a lot of energy management or even energy conservation, especially energy conservation projects, is that when you save $1, it goes directly to the bottom line. And that is quite different than other types of projects out there. If you have a project where you're trying to sell something, you have to make sales, you have to develop a sales force, a distribution channel, maybe human resources around this. With energy projects, you save energy, that goes directly to the bottom line, and that is direct profit dollars. So they're very, very good. But often, a lot of good energy management projects, and whenever I say good, I'm talking about projects that have a 3-year payback or better. So they're either a 30% return to greater than that, 100%, 200% return, et cetera. Any project that's in that category is what I would call a good project. And a lot of those projects still are not being implemented. Why is that? And the main reason is money. The main reason is lack of capital, especially in today's economy. Businesses are extremely frugal with their money, and they don't want to spend money on anything what we might call discretionary. And about 34% of the reasons projects don't get implemented or they get delayed is due to lack of upfront capital. Now, that's an interesting argument, and that's an interesting point, and a very valid point. But we can find financial ways to get around this. And the key point that I want to make here is that a lot of companies might not understand this, or any organization really, is that energy projects generally are about saving money that you're already spending right now. So you're already wasting the money right now. And there's a reality check that needs to be heard if you're trying to sell an energy management project, is that this project is about saving money, and by the way, if we do nothing, you may think that may have no impact, but in reality, doing nothing, we're still throwing away money out the window every single month. So that's a good point. Sometimes people react more to pain than they would the pleasure of actually saving something. They have to understand that they're actually wasting the money right now. It's happening whether we do the project or not. They're wasting the money. If we do nothing, we continue to waste that money. If we do the project, we're going to save some of that money. So, you know, it's kind of a reality check you might want to have if you're having problems with people understanding what we're talking about. And the whole, you know, reason financing works is often the cost of delay, the cost of any time we postpone a project till later on, or we don't do the project at all, we're still throwing money out the window. The cost of delay is often much, much greater than the cost of financing. You might have to, if you're losing 20% on some process, and you could, you know, basically just think of it as you're throwing 20% of your money away every single month, and you could get that back, and you might have to pay finance costs of 10%. You're still 10% positive. You know, if you pay 10% finance fees, you're still getting 10% back. So that's a real advantage that's often underrepresented. And as I mentioned, these the nature of these projects are so sound that stock prices have been proven to go up. And this is a study we did, God, I'm getting old, almost 13 years ago. We published this, and that means we did the work nearly 14 years ago. We found that when firms announce energy management projects, stockholders, shareholders, Wall Street reacts positively. This is actual measurements. We measured the New York Stock Exchange for several companies, many companies, and found that their stock price went up 21% roughly within 150 days of the announcement. And that's because we think that shareholders and people on Wall Street see, hey, if a firm is investing in energy management projects, those might have a 3 to 5 year payback. In some cases, some of these projects had even a 10-year payback, you know, 10% return roughly. And when firms do that, that sends a signal to Wall Street to say, hey, this firm, you know, is thinking long term. They're going to be around more than just a quarter. We like that, and shareholders tend to invest in companies like that. So that's what we think happens. We never really found out. But this paper's been published all over the place, and now has been recently published in China in Mandarin Chinese. And that happened earlier this year. So still a very interesting paper. Definitely can get the attention of CFOs. If you want to share that with them, feel free. You can download this whole paper on our website at no cost. But back to the point here is that, you know, real world, when we're dealing with trying to make decisions, financial constraints are the primary reason why energy management projects are not implemented. Like I said, 34%, that's the majority. All the other reasons are either marketing or other reasons that, you know, are less than the money reason. And often, like I say, the facility manager or the CFO doesn't have enough cash on hand to allocate the funds, even on really, really good projects, or he can't get the, you know, we might call this first cost. And in fact, some research we've done recently, or not recently, but after the first study, was that many facility managers don't even understand the primary differences between different arrangements. They don't even know what's available to them to help them get these projects implemented. And so that's why we created this seminar and this content. We've given several speeches about this at major conferences, and this is the whole goal, is to help that facility manager understand the different ways that he can get something done. And so that's what this is about. Other good reasons projects don't, you know, occur is that facility management wants to focus on our core business, maybe not so interested in energy management projects, all kinds of other reasons, but money is the main one. Okay, so we call these alternative financial arrangements, and I'll use that term financial arrangements or financial vehicle. Primarily we're talking about loans, bonds, leases, et cetera, anything that can mitigate that first cost or mitigate the financial, you know, the cash flow out of the project to the facility manager. And there have been banks and companies and finance companies and, you know, third parties that get involved in financing. You can see this in the solar market with PPAs. I mean, 60% of the deals done in California for solar projects in 2007 were done using a financial instrument very similar to the financial instruments we're used to in performance contracting: loans, bonds, leases, etc. But generally, a way of specializing in energy management projects. That's what these finance companies are doing. They understand the risk. They understand that the payments and some of the collateral is a little different than your standard investments, and they're willing to fund. And that's kind of exciting. I still go to conferences and hear these specialty firms out there that are willing to fund in energy management projects. The federal government has, developed several executive orders and other programs to, help get more projects done through performance contracting or financial arrangements, and they've even developed software to help, facility managers evaluate financial arrangements. Energy Star is a good example. They have Portfolio Manager. They have all these tools to help, people plug and chug numbers. You can also plug and chug numbers on Microsoft Excel, etc. And all of those things are based on numbers, hard dollar numbers. There's also some soft dollars or site-specific issues that often are not addressed, and we will be addressing those here. We'll be talking about some of the soft costs or the soft characteristics that influence financial arrangements. So some of the characteristics that influence which financial arrangement is best, we could categorize these into three types of characteristics. One is a facility characteristic. Another one is a project characteristic. And so, facility is related to, this is a big facility, small facility, sophisticated maintenance team, not sophisticated maintenance team. Project would be, complex project versus not complex. Project could be, location-based. Project could be anything about the project. And then financial arrangement characteristics, there are even some according to that. And we'll cover all of this stuff in the next 30 minutes or so. So facility characteristics, the facility obviously has an existing financial condition, and the cost of capital, the capital that they're assigned, the credit rating is the biggest thing. Your credit determines what kind of rate you're going to get as far as borrowing money, which is what we're calling cost of capital here. And that really comes down to the lender's assessment of the risk. Now, if they're familiar with energy management projects, you're going to probably get a more favorable rating. If you're dealing with a bank that's never done an energy management project before, it's going to be unfamiliar territory to them, and they're looking at you and they're trying to assess your credit rating. But if they don't understand what energy management projects and how the cash flows occur as a result of the energy savings or maintenance savings or some other benefit, they may have a hard time understanding the cash flow potential, and they might have a hard time financing the deal, and they may charge you a higher rate to account for the apparent risk to them. Even if there is no apparent risk, they may have some, and they'll charge you a higher rate. But the credit rating of your facility is probably the biggest thing. If your credit is poor, it's just harder to get money. No matter who you are, it doesn't matter what you've done. If your credit is poor, it's difficult to get funding. Other thing about the facilities, depending on types of facilities, if it's utility, if it's a government, or if you work with utilities or there's special utility programs around, you may be able to get rebates or grant funding from the government. Now, the solar or renewable energy program that is available now through recent legislation, you could get a tax credit or tax rebate. Tax credit essentially shows up as like cash. It basically reduces the front cost of your project. Although, by the way, you still have to front the money, and then you get your rebate next year. But it's 1 year basically you're getting money that takes away the real cost of the project. If you're in a company that is profitable or not profitable, I'm sorry, if you're profitable, you can do tax credits. That's great. If you're not profitable or you're a government entity, you may be able to get grant funding through that same legislation, which is basically like getting money, because if you're not profitable, obviously you're not paying taxes. So there's still ways to get money for projects, for good projects, even if you can't take a real tax credit, but you could take a grant. And there's also special programs for the government. Many of you may know that there's been some executive orders signed, and I'll be talking about more of this tomorrow with a different group. But executive orders in the federal government have mandated they have to have a plan to go net zero energy buildings for government facilities and eventually carbon-free buildings. And so all of that is going to drive a lot of activity, and facility managers are going to be saying, well, I got to do that, but I don't have any money to do that. And they may be able to get special funding from the DOE to accomplish those goals. Specifically, it's a mandate. So we'll see how that all plays out. Maybe not. Who knows? Maybe the government will say you got to do this, and we're not going to tell you or help you get there. That wouldn't be foreign either. So anyway, there's all kinds of special things out there. If you look at your local rebate, if you go to a website called desireusa.org, we've talked about this in other webinars, and be careful how you spell that, but if you Google that, DSIRE-USA.org, you can find all kinds of ways to get money. And a lot of that is utility rebates for demand-side management programs, or state and local tax rebates. There's all kinds of programs out there, and you can get that money to obtain special funding for your project. And some of that will depend on what kind of facility you are, obviously. Now, if, as I say, you're government, you may be able to get some type of tax-exempt interest rate. There's all kinds of, if you will, games you can play with different financial arrangements where if the tax benefits are worth something, you can have a third party get involved and have them, as a private company, achieve these tax rebates for you to help the project economics. If you're doing a straight government, maybe maybe you can't do that. But in some cases, I've seen the government work some of the assets through a third party taxable entity so they can get the tax benefits. Okay, so and if your government, maybe this works, maybe it doesn't. It just depends on how creative you are. Other facility characteristics. Oh, this is the big one. The in-house staff. Are they skilled? Are they sophisticated? Do they have good training? Can they handle energy management projects? If they're used to energy management projects, that's great. You probably can handle more projects and finance them yourselves and manage them yourselves. If the facility managers, in many pharmaceutical environments or places high tech, for example, they're focused, those facility managers are very focused on the process equipment. They don't really get involved with the facility energy, and they might not be the best people to be, working with your project. But if that's all you've got, they may not be so excited about managing an energy management program and getting involved with, the monitoring required for the financing, et cetera. So that can be a huge thing. So how sophisticated and how willing your in-house staff is a big thing. Perhaps additional resources we need for maintenance administration once you do a project. I can think of several performance contracting projects where we, as part of the project, we had to monitor and make sure everything was working, and we added maintenance resources to make sure that was going to happen. So those are conditions that, if they don't have it in the facility, part of your project might be to put it in or to enable it or do automation or controls or some kind of way to make the job of those maintenance people easier so they can accomplish what needs to get accomplished. And then, of course, the facility's long-term business plan. If you're working with a facility that's planning on moving in 2 to 3 years, they might not be a good match for an energy management project, although I can think of several where that's happened. If you understand their long-term business plan, that's important and it will impact what type of financial arrangement they may choose. Also, their commitment to non-core business. If they're just a company that focuses on their core business and does not get engaged with anything else, they may be wasting a ton of money. But if they're not committed to that, if they don't understand or ever want to fix that they're losing lots of money, you're probably not going to be able to change that either. So those are some characteristics more from a sales perspective, but do matter with respect to facilities you can choose. Now let's get into projects. This is important. Every project's different, and every project has a different cash flow. So the project's cash flow schedule and the variance in cash flows is one of the key characteristics of which financial arrangement you choose. If it's very, very predictable, that might steer you in one direction. If its variance is high, that might steer you in a totally different direction. So cash flow schedule matters a lot. The ability to obtain rebates like demand-side management, utility rebates like I mentioned on Desire USA, that can have an impact on what type of rebates you're doing. And if you're doing a lighting retrofit project where you're changing the technology, you probably could get a rebate on DSM. If you're doing an occupancy sensor-based lighting retrofit, you may not be able to get rebates because there's no guarantee that those lights are going to be off during the hours of peak operation. And peak, everyone knows here that you're charged more during the peak period. So that's the whole basis of the DSM programs. If it's a thermal energy storage, it might have some ability. If it's a motor retrofit, or all these different projects have different ability to get rebates, and that can impact the type of cash flow and then ultimately the financing vehicle. Or maybe you don't need financing. That can all help you in different ways. Project's risk to the host. If the project is something that's never been done before, like as in the next line it says complexity and additional burden on the in-house resources. If we're talking about putting lights on the space shuttle or something, this is a very complex project. It has a lot of specific variables. If you're putting lights in a room that gets wet every day because of the washdown procedures in a food facility, that might be more complex, or trying a new technology, LED lighting, that might create additional burden on your maintenance team. So again, it just depends on how complex the project is. Will favor different types of financial arrangements. And then does the facility need the equipment for the long term? If it's something, is it peak shaving equipment during the summer, like a generator you're bringing in, or is it something that's going to be part of the asset base? How it's treated from a tax and amortization schedule can also impact that, and that's generally related to the project and the facility as well. What will be the residual value of the equipment? Sometimes you put in equipment with an expected salvage value, and different types of projects, have different types of salvage value. So it depends on the facility as well. But what will be the residual value? If it's high, you may want to keep it. If it's low, you may want to lease it, or vice versa. It can go either way. So project characteristics are a big one. And then financial arrangement characteristics, this is important. How different financial arrangements, take money or give money at different times. So if you're a loan, you're getting all the money up front. If you're a bond, again, you're getting all the money up front. But how you're paying that back in a loan and a bond can differ. With a loan, you're paying back principal and interest. With a bond, usually just paying back the interest, and at the very end, you have this big balloon payment. Well, all the structure of those cash flows can be important in figuring out what is the best net present value of a particular arrangement. Some of them will have tax advantages, some will not, and some can be structured to have advantages, tax advantages, and then at the end, possibly depreciation advantages. So I don't want to go down the Enron road here, but there are ways you can structure things using the tax laws to your advantage. And I encourage you to get an accountant or get someone who knows what they're talking about with that. But a lot of different variables you can leverage there, just to be aware that it's there. Sometimes if you take additional loan out, it can have an impact on your corporate capital structure, your debt-to-equity ratio. Pretty much any project now under the FASB rules, which is the Financial Accounting Standards Bureau, I believe, or board, I get them mixed up. If you take out big loans to do energy management projects, there used to be this thing we could do called an operating lease where we keep everything off the books. Now you pretty much have to have those other assets listed as footnotes or some other thing. So it really does show up as a liability, either on your balance sheet or in the notes column, and so that people or investors or shareholders are aware of, that your money is maybe more tied up than what would be formally indicated on the old accounting records. So a lot of things like that, how much money you can take out, debt-to-equity ratios can impact the different arrangement that you can choose. Contingency plans. Some of these projects have heavy-duty contracts with them. If you're a solar PPA, you're putting in a power purchase agreement, and all of a sudden you've got all these solar panels on your roof. They're owned by someone else, and all of a sudden your roof starts to leak. Okay, so well, how flexible is your contract to allow someone to come in and move those panels? Does it void your solar PPA contract, so you can fix the roof? There's all kinds of little contract things you got to think about in some of these more complex arrangements. And so, changes in operating hours. Say you're working at an airport and you have to install lights on the dormant runway, and all of a sudden that runway becomes the active runway, and your operating hours just went from maybe 15 hours a day to 3. You have to be able to adjust, the ability to adjust the project and be flexible. And sometimes the loans can be extended. In some cases, they can be accelerated. The flexibility of the arrangement to handle contingencies like that, hailstorms, et cetera, insurance for roofs in the PPA example is one solution to that. But, ways to handle, changes in the operating hours or effective pieces of the contract. What if you hit a tough time and you can't make payments? Is there a way to, take IOUs for 3 months? Are there extreme penalties? And like as they say in credit cards, all your payments due now and you have to pay interest on everything. Do they charge you excessive penalties? All of this stuff, all of these little contract details can make a big deal. And actually, in many ways, these little details sometimes kill performance contracts that are pretty good, but they have all this boilerplate language that just failures the performance contract company because it's the boilerplate that can really break projects apart. So just working through these issues, usually you can work through them if you're aware of them, how to handle some of the contingencies and et cetera, so that it's reasonable, so that, if in the event the project is for some reason not as successful as it should be, you can work around it and make changes or expand the scope or fix it or whatever you need to do. Is a warranty provided is a perfect example. Okay, I'll talk more about that. Primarily this applies to performance contracts, but in part of my dissertation a long time ago, we did a survey with many facility managers to try to understand what are the top 10 list of objectives that they consider when selecting a financial arrangement. And this is research you don't really find out in the inner space because we haven't talked about it much, but it is very, very interesting. Here are the top 10. So obviously, the facility managers want the thing to have a high net present value. and many facility managers want to reduce risk. Now, that can be accomplished through having a guaranteed savings performance contract, but I think what they're really saying here is they want to reduce the hassle. If they can reduce hassle, that's generally a pretty good thing, and that goes right in line with number 3, to minimize the additional impact on maintenance and energy management terms. And there's all these other ones, easy to understand contract, et cetera, pretty common sense things, but you do see these show up. In a way to compare this or take a look at this from a decision management standpoint, on a lot of the soft cost issues as well as the hard cost issues, we put together this little spreadsheet, or what I would call a decision tree, to go through. And the primary effort here is just to try to pick the best arrangement. So you might have energy management project characteristics. These are the ones that are indicated in red. The complexity, the reliability of the project. Is this something we've done before? Lighting retrofit versus a new chiller with a variable speed drive and new variable speed pumps and all of this more complex areas. Is the equipment long-term? Is it peak shaving, or is it a motor that's going to be in there for 10 years? And the cash flow schedule. When do we get the money? When do we have to pay the money? All of those things are project characteristics that might influence you, either to manage or outsource. And then facility characteristics, your in-house staff, your management strategic focus. Are they willing to manage projects all their own, or are they more apt to outsource? Are they moving facilities? Are they planning on moving the whole campus or expanding the campus? Fit buildings that are basically going to be torn down anyway or retrofitted, and then, what are they willing to commit capital? All of these things are facility characteristics or management characteristics, pretty much the in-house staff experience being one of the primary ones that influences whether you manage or outsource. So if you manage it, you're going to come into what we call host-manage arrangements or direct purchase agreements. Another one, if you outsource, you're going the route of performance contracting, and I'm using performance contracting kind of a generalist term that I'll define later. But just for now, that's kind of the manage versus outsource. If you manage it, if it's a short time frame, you may consider doing a true lease, because that's a financial arrangement similar to renting. That's something that's very quick and easy and something that works for short time frames. Long time frames, then you're going to ask if you're government or private. If you're government, there's a pretty good chance you're going to raise the money through a bond, and that'll be done through a community or some other type of offering, or maybe a federal government bond. If you're private, then you're going to look at, on or off balance sheet. This issue's gone away quite. It's not as big of a decision point anymore, because when you go off balance sheet, there's still notes, et cetera, like I described, that would indicate the asset doesn't just disappear. So, this one is not so much of a decision anymore. But generally, then you start looking at net present value, the quantitative factors of the interest rate, the tax bracket you're in. Are you profitable this year? Are you paying taxes? Are you doing government grants, et cetera? And the timing of the cash flows. Again, all of these things kind of influence the NPV, and that can help you decide whether to do loan or capital lease, et cetera, or even true lease in this case. So that's kind of just an overview, just a summary of some of the different things you want to think about when you're looking at these types of arrangements. Okay, so let's talk about the specifics on these different types of arrangements. Talked a lot about some of the quantitative or qualitative factors, from kind of a more of a philosophical standpoint. Now let's get down into some of the primary things here, and I'm going to talk in detail about there's really 4 or 5 different basic ways to finance, and there's about 100 different hybrids that you can put these together. But the primary ones that I want to classify here, characterize, are equity, which is using cash. Using cash, you've got money, you buy a project, you get the savings. Borrowing money, you don't have the cash, so you borrow money from the bank, and you have to make payments, and the results in a finance cost. Leasing is like renting, but we'll talk about capital leases as well. And then performance contracting is really not necessarily a financial arrangement at all, but often every time a performance contract done, most of the time it involves some type of financing, and we'll talk about how that relates with it as well. In a quick nutshell, performance contract is basically a guarantee by the contractor that the equipment will meet some specific performance measures, whether it be light levels on the desk or air conditioning at 72 degrees. And by the way, we'll do these things and also save you 15–20%. That's a typical performance contract. So that the idea is that the contractor has no incentive to cut cost on the installation. He's tied to the performance, which is unlike how most buildings are built. When we build buildings, we're always, the contractor's going for the lowest cost, and they can cut corners. If they can get everything installed and inspected and it works, they may put in equipment that lasts 5 years versus something that lasts 15 years. They can do that because they're not usually held to performance. But performance contracting really ties the contractor's hands at the point of operation, and how is it operating instead of just at the point of installation. So a little bit different there. And performance contracts can use leases, bonds, loans, any kind of hybrid of those, but that's kind of how that ties together. So we'll talk about performance contracting, the financing, the benefits, the risks, and then and as a kind of a subset of performance contracting, I don't want to mention this too much, but I'll go through it right now, is on measurement and verification, because this is a very big piece of performance contracting. You have to get a third party to verify and measure that this thing is actually working, that it's actually saving money, that the operation is as the contractor said it would be. And that's very important. There's a whole protocol, a guideline on how to do measurement and verification. It's a good, publication is called the International Performance, IPMVP, International Protocol for Measurement and Verification Practices, et cetera. And there's all kinds of ways, different, ways to do M&V. You can do speculated savings, stipulated savings, different types of savings vehicles that optimize your M&V costs. The reason I bring this up is banks often, before they're going to lend on something, they often want to see the M&V plan. They want to also do an M&V on the audit to make sure whatever the audit said the energy savings are, they get some other third party in there to verify that those savings are actually going to happen. It's a lot like, if you're going to take out a loan on your boat, the collateral is the boat, right? Or if you take a loan on your car or your house, the collateral is the asset. In performance contracting and energy projects, they really don't have that kind of asset, because if you put in lighting fixtures somewhere, first of all, the value is in the savings. It's not in the lighting fixtures, right? The value is in the savings. Because if you go rip out the lighting fixture, if, say, everyone defaults and the company goes bankrupt, the bank just is not going to come in, rip out the lighting fixtures, and walk away and try to resell them. Usually it doesn't happen. But the collateral, the value to the bank is in the savings. So they want to make sure that if the thing's going to save 20, 30%, that they're reasonably sure that it will save 20, 30% before they fund the project. So often with performance contracting, you're going to have a step in there with M&V where someone from the bank or some energy auditor from the bank or hired by the bank is going to come in and look at how the savings were estimated and verify that they're realistic. And so that's part of the funding process. That's why I want to mention it here. I think that's about it on M&V, but we can take questions at the end on more on M&V, but it is part of the process in the funding process. So 4 basic ways to finance. We'll get right into this. You got equity, borrow, lease, performance contracting. Equity meaning cash. And so when I say direct purchase with in-house cash, we're talking about the company has the money, sitting in a bank account. They've got available cash to implement the project. Now, this doesn't always happen. We could do a quick poll on how many of you just have a couple $1 million hanging around to, just in case an energy management project comes up. It's not very common. Companies don't keep money just sitting around in the bank in case some great project comes up. They usually have their money invested in their process or in the places where they know they can get the most money, which coincidentally isn't always the bank. So in the case that they do have money just sitting around or they can get money, this usually can be the most profitable approach because you're not paying any finance costs. You get to keep all the revenue, et cetera. Now, that's not always true. In some places, in fact, many places, the net present value on a finance deal might be better because you have tax benefits, and that might be advantageous to you in certain types of places. For example, we have personally, we have loans on our cars and our houses, et cetera, but we're always paying off the ones on the cars first because the loans on the houses we can tax deduct. And so, it's a strategy. Of some places it pays to have some taxable benefits. In some places it doesn't. So it just depends on everybody's situation, and everybody, I'd say, just like every company situation. Anyway, so the reality is most people don't have cash. Cash is usually short supply, so most projects at the point, if you say, hey, I could save you $2 million if you give me $1 million tomorrow, a lot of them don't just have $1 million. So the project doesn't get implemented, gets delayed, and that's a big problem. Going with this route, though, if you're managing it and paying for it yourself, often you're looking at you're going to have to manage and maintain the equipment. Sometimes performance contractors will get involved with this, but most of the time in this situation, people buy it themselves. They're usually managing it themselves. It doesn't always have to work this way, but sometimes it is. The cash flow diagram I'm going to show you, which is really a cash flow table. It's not really a diagram. It's a table. It's an Excel spreadsheet. And I want to make an upfront disclaimer on all of these little spreadsheets. These are all basically spreadsheets that were taken from the finance chapter of my book, and you can go read that if you want to. It's a great, 2-page summary investments, and there's also more detail. But all of these pictures you're going to see of the different tables for cash and table for savings and table for true lease and capital lease and performance contract. They're all based on some just random assumptions. We plugged in some numbers there and just saw how these things would work. This doesn't mean that these things are set in stone. I mean, all of these investment variables can change. If you get a different interest rate, for example, if you have a different size project, for example, you're going to put in different numbers. But you're welcome to use the model to see how the net present value would factor out. So here's the economics of purchasing equipment with cash on hand. And basically I'm going to just go through this table really quick, and it's the same table we'll use for all the examples. This is on the left-hand side here. This is end of year column. So end of year 0 is the year that you install the project or invest in the project. End of year 1 is end of year 1. End of year 2, 3, 4, 5, etc. And then 5 star. Whenever you see that, that might be we have a salvage value or a balloon payment or a instead of a salvage value, a disposal cost, or something that happens also in the year 5, documenting the end of the project, some other cash flow that happens. And these are the different types of cash flows. So you can see end of year 0, nothing, we haven't saved any money yet. We just are installing the machine. It hasn't really been turned on to save money. So we got nothing going on here, but we did invest the money to buy the project. And if we were making this investment, we would just be taking $2.5 million out of the bank, and that would be our payment. We'd be paying it once at the beginning of the project. There is no loan, there's no payments or principal or interest, and there's no taxable income because we haven't saved any money yet. So our after-tax cash flow is basic minus $2.5 million. Now, if you have a tax credit or something, that might show up in these columns. But essentially, we're spending $2.5 million of our money. At the end of the first year, we might save $950,000, and we also get to depreciate. Now, depreciation is kind of a funny one. Let me just explain. Depreciation is not a cash flow. The only reason depreciation exists is to document the loss in book value of an asset. I'll say that again. Depreciation exists to document the loss in book value of an asset. Now, this asset has a value, obviously $2.5 million, and depreciated each year you're allowed to take out some of the value. In terms, the way they typically do it is this is, I forgot the term, makers or whatever, but this is where they're taking out, a certain percentage of the value. The next year they're taking about twice that much, and then they have this kind of scale so that if you add up all the depreciation numbers, it results in $2.5 million. That's kind of a gut check to make sure you're on the right track. Sometimes straight line depreciation would be equal. So if you got a 5-year project, you would depreciate $500,000 each year. 5 times 500,000 would be 2.5 million. So you could have 500, 500, 500, 500, et cetera. In some cases, you can depreciate faster. Generally, if you depreciate faster, that means better cash flow, better project economics. But just in general, that's what the depreciation column is here. So first year, we saved $950,000. And what we get to do with depreciation, it's not really a cash flow, but it does reduce our taxable income. So the taxable income over here, this column, basically equals the savings minus the depreciation. So $950,000 minus $357 hopefully is $592. Otherwise, I've got problems with Microsoft Excel. And then basically, so we have roughly almost $600,000 in taxable income. That's good because then we're not going to be paying taxes on $950. We're only paying taxes on roughly $600,000. And the tax on $600,000 at all these interest rates, which are or tax rates, which are variable again, is $200,000 in tax. Now the after-tax cash flow, what we're doing here is we're taking the first column, or the second column really, the savings dollars, $950,000, and subtracting off the tax. And when we do that, 950 minus 201 gives us $748,000 roughly in our after-tax cash flow. Just give me a quick yes if you guys understand what this is about. Just want to go through, see if you guys are following me on this. Give me a yes in the question and answer bar. That'd be great. And if you don't understand and I don't know, then I can't help you. So if you don't understand, please say that as well. But I'm seeing no one saying no, so we're going to keep going. But that's kind of the basic idea of a cash. Very, very simple. I mean, this is, people like cash because it's simple. If you can get funding and you can, save $950,000, put in $2.5 million to save $950 for 5 years, that's great. And every year, same process. You'll have $950,000, take off the depreciation, you get a taxable income. Then from there, you'll multiply by whatever the tax rate is down here, 34%, and then you get a tax, and then to get the after-tax cash flow, you take the savings minus the tax. So again, 950 minus 114, pretty big after-tax cash flow in year 2 because of the depreciation reduced our taxes so much that year. So very interesting. You run through these numbers, you keep doing it every single year, and then what you have is the ability, you have this cash flow, you spent $2.5 million, and after taxes, which is really an accurate way to do it because you're spending the money in after taxes, you're spending, the money you receive, assuming your project is savings, assuming those savings would make your company more profitable, you are going to pay tax on that additional profit. And so the proper way to do this is run your net present value off of after-tax cash flow. If your company's not profitable, then you're probably not going to be paying taxes, and you would actually have an even higher after-tax cash flow related to the project. But if you're not profitable, you got bigger problems anyway. So this is how you do this, and we're not going to cover the time value of money in here. That is a whole 2-3 hour live presentation with diagrams and lots of drawing for me to transmit that kind of information. But if you have problems understanding how you get from all of these cash flows occurring over time and how they're discounted to get a net present value, you probably want to pick up an economics book or engineering economy or something called time value money, or Google it and Wikipedia, read about it, because it's a very simple concept that's used to figure out this thing called net present value. And basically the idea is that we're getting all this money at different points in time out in the future, end of year 1, 2, 3, 4, 5, and we basically move all of that money, move it back through time to figure out what it's worth today. Because if I ask you, money today is worth more than money tomorrow, that's the whole concept here, is moving this money back through time to figure out what it's worth today and comparing that positive benefit versus the cost we're spending, and that's what you're getting as the net present value. And the rate at which you discount these cash flows is the interest rate, which is also called minimum attractive rate of return. So that's kind of what we're doing here. And I didn't mention this 5-star here looks like it has a salvage value of $1.2 million at the end, and we run that final cash flow line there. Now, in some cases, depreciation can be handled a little different, but just in general, this is a basic way to do it. And again, you get a nice after-tax cash flow stream. We run all those numbers in a net present value calculation, which you can also do in Microsoft Excel or some of the project tools on EPA website, et cetera, and you can figure out all these other variables. The minimum attractive rate is 18%. For some of you, that might be 10%. For some of you, it might be 50%. You need to change that, and that will change the net present value. According to your organization, you should plug in the right number. Your tax rate may be 34%, maybe 27%, I don't know. But that's another variable you can change. And then we talk about maker's depreciation for 7-year property, so that's why we have all this stuff here. Like I said, it's a book value at the end of year 5. We still had $669,000 in book value on that asset, but we sell it for $1.2 million. Then we basically are depreciating the rest of it, and so that's why the market value was $1.2 million. Again, that's an estimated number. We'll never really know until we reach end of year 5, but that's kind of how you end up with these numbers. So we're taxed basically on, we sold that thing, we got $1.2 million in revenue. We take off that final depreciation, and we're taxed on $530,000 in the final year. So that's kind of, and that's in addition to what we already. A way to how to handle this is how this works. These basic spreadsheet models, and that's cash on hand. So let's go on. Let's talk about using borrowed money. So this is where you're direct purchasing. This is also a very common performance contract. Sometimes you'll have a performance contract where the contractor is guaranteeing the savings cash flow, that it's going to be a certain percent, and the loan is handled separately. We did a project at Tulsa International Airport where we guaranteed the savings was going to be there from putting in lights and all this other stuff, and they went to their traditional lender, got a bond or a loan. I can't really remember what they did, but they got some money. And basically, they were required to pay back the loan, and we were required to make sure the savings was going to be there. And as long as the savings cash flow every year was bigger than the loan payment, everybody's happy. And so that's another way to go. So that's a quick example. So direct purchase using borrowed money. The company borrows money from the lender, the financial institution, insurance company, vendor, third party, whoever, to implement the project. They're going to be paying the interest, and it may not be as attractive as using cash and paying no finance fee, but it may be exactly the opposite. In this way, when you borrow money to pay for a project, you get to save or preserve your in-house cash, and you can use that for other purposes, which is often very handy. one of the benefits of using borrowed money is that if you're a private corporation or any kind of corporation, if you're not government, the loan is tax deductible. The interest on the loan is tax deductible. And that also will reduce your taxable income. We're going to show you how to do that in a second. Usually in these types of arrangements, whenever you're doing this direct purchase thing, you're kind of indicating that you're going to be managing and maintaining the equipment as well as the risk. But it could, like I said, be combined with a performance contract. Here's the economics of this situation. Notice it's a little more complicated now. Now we have this thing in here called payments where we didn't have this before. We just had, this whole was kind of blank, these three columns here. But let's take a look at what we got going on. At the end of year 0, we basically, we take out a loan for $2.5 million instead of funding that ourselves. So our after-tax cash flow is basically 0. If you look at this way, is we get $2.5 million from the bank. That goes right into the project. We spend it at the end of year 0 or during the year 0. So we're taking out a loan here, but our after-tax cash flow is really 0. And so the end of the first year, we got $950,000 in savings, same depreciation numbers, but now we have this payment. And we have to pay the bank. We saved $950,000, and this is kind of an extreme case. For the loan to the bank, we owe the bank $745,000. Now, we didn't pay anything up front. But we have to pay $745,000 for the next 5 years in a row. And part of that $745,000 is principal, and part of it is interest. So $370,000 roughly is principal, and $375,000 is interest. And you can see as time goes on, the interest gets less and less, and the principal gets more and more. It's just like your mortgage on your house. There's really nothing more to this than that. But essentially, this is going to eat up some of our savings when we're making payments. So let's look at how this works. Savings first, we have $950,000. We take off depreciation. We're trying to figure out what our tax, to figure out our taxable income. I'm going to do that first, and then we'll talk about after-tax cash flow. We take savings. We take off depreciation, same as before. We also get to take off another $375,000 of interest payments because that is tax deductible. So we take that off, and we're only left with $217,000 in taxable income. Let's go back and take a look at what our taxable income in the other example. Our taxable income was $592,000 in the other way using cash on hand. Now our taxable income is only $217,000 or $750. So our taxable income has gone down significantly. Our tax is only $74,000 for that year. So our after-tax cash flow is $130,000. Okay. And let's go back and look at what the after-tax cash flow for the other one. Of course, it's higher. It's $748,000. But again, we didn't have to spend $2.5 million up front. We didn't have that, real big, what's the word I'm looking at, hitter in the beginning. We don't have to spend any money. And at the end of the first year, we got $130,000 in positive cash flow. And that's really the beauty of this, is that we're not really spending money up front. We're getting $130,000 we did not get the year before. We're getting that with no upfront investment. That's really kind of an advantage to this. So after-tax cash flow, that is that. Now let's take a look at some of the other things. We have, principal, interest, payments, etc. The after-tax, we figured out the tax was much less. The after-tax cash flow is going to be the savings minus the principal. Okay, we got $950,000. We subtract off $370,000 in principal, right? Because we're going to pay that out to the bank. We're also going to be paying, or we could actually just make this quite simpler. We're going to pay out the savings. We're going to pay out the total payments, because that money, interest, and payments are coming out. The principal and interest are coming out. So we have $950,000 minus $740,000. I lost my mouse here. Come back. Okay, $950,000 minus $745,000 minus the tax we pay. And I think if we added that all together, hopefully we would have $130,000 left over. Let's check it again in the next year. We have savings of $950,000. We got to pay the bank $745,000. So that, if I'm in my math in my head, that leaves like $105,000 left over. And we have, obviously I didn't do my math right. Somehow I've screwed this up, but trust me, this works. Let's see, $950,000 minus $745,000, so it's almost $746,000 minus the extra $6,000 in taxes, and that's what we're left with here on after-tax cash flow. Keep in mind, the depreciation is not really a straight cash flow. Basically, if you run these numbers in this manner, you're going to get a similar type thing, and if I screwed it up, I screwed it up, but basically the logic is there, that you get an after-tax cash flow here. Notice what's interesting is in the year 5, because your after-tax, because your tax is so heavy, you actually have a negative after-tax flow, which is kind of interesting. But ultimately, at the end of this one, using a loan, you're still going to sell the asset, still going to have the same kind of thing going on in the last year, and you're going to have this kind of bumper crop this last year. So kind of interesting, and these can be different again if you change the interest rate, change the tax rate, change any one of these things. Notice we charged a 15% loan rate, a loan finance rate, which was kind of an interesting way to attack this, just to throw another level of variability in there. But basically, you can have all these scenarios and resulting in a certain NPV. And again, any one of the variables changes, you've got a situation that can change on the after-tax cash flow as well. And so that's what a loan is about, paying principal and interest, very much like your mortgage on your house, nothing really terribly different there. Bond is very, very similar to a loan in function, except typically with a bond, and this is typically done by government agencies, they basically take out a chunk of money, you pay the interest back every single year, and at the end of the time frame, 10 years, 5 years, whatever, you pay back a lump sum again. So usually a little bit different. There's a lot of other details here that you can read about, but essentially notice the difference in the payments is that you have this principal coming to you, and again, that's going right back into the project, so your after-tax cash flow is zero, and then you pay interest only for the 5 years, and then at the very end, the end of the 5th year, you got a big balloon payment you got to pay back. And so you'll notice that the taxes on this and the after-tax cash flow kind of vary all over the place, because at the end you got to pay back this money. But ultimately, you can see the net present value. And again, don't read into this that this net present value is higher than the one before or less, but just that's because some of the variables here. And you change the variables, you're going to get different numbers. But just for an example, what we're trying to show is the way these change with respect to the interest payments and the principals. The difference is the primary difference between a loan and a bond is that. Okay, now one other term we didn't really talk about, and this really is a slide I probably should move back up to the front, because this is about using stock to pay for a project. And this is not done very often or directly done related to energy projects, but it could be done. There's no difference in selling stock versus you're selling stock, you're getting investors to give you some money for a piece of the company, and basically you're raising cash, and from that point forward, you treat it exactly as you would a cash investment. So not typically done, but another way that's interesting, it has some issues with it. I mean, there's usually a lot more legal ramifications, and selling stock is not something that's easy to do, so it doesn't really get done, and sometimes you must pay dividends, and there's a whole bunch of other complexities here. But it's possible you could do it this way. And if you were to do that, you sell $2.5 million in stock, and you purchase the equipment, so the money comes from the investors and goes right to the project. Again, after-tax cash flow is zero. In this case, you'd have to pay dividend payments, and then again, at some point, you're going to have to pay back the $2.5 million. And that, if your stock appreciates, that might be easy to do. If not, it might be difficult to do. But that's kind of how this could work. Of course, if your stock went to zero, that's one advantage, is you might not ever have to pay that back. Now, we have a lot of Wall Street people that are experts at that, so we won't go there. But that's just another option for you, and we have this slide just to show you what that might look like. Now, leasing. This is a fun one to talk about. Leasing equipment is essentially like renting, and there's a term called a true lease, also called an operating lease, and that is where it is truly like a lease. It's basically truly like renting. Sorry, I can't talk. If you go to the airport and rent a car, some would say you're leasing the car. You get to use the car, you might pay the gas or some minimum expense, but you're not maintaining the car, you're not owning the car, depreciating the car. You're basically borrowing an asset for a certain period of time and paying a fee for the ability to rent the asset. This is usually used for equipment that has very, very short life, like renting a peak shaving generator, or even an ice system. I've seen that done before, although not common. Something that would be used just for a certain period of time, then it goes back. It says the equipment never appears on the company balance sheet, but generally that's not necessarily true. Now it would show up as a footnote or some other place. It can't just be not on the books. There used to be these financial indicators called return on assets, and leases would be very attractive for that. That's one of the reasons why Enron was so hard to figure out, is they could put a lot of stuff on off-balance sheet financing, I should say. So anyway, that's just another piece of this. Leasing, whether it's called a true lease or an operating lease, it must be the case where it's basically renting. The company really never owns the equipment, and the other thing is they can't agree to buy the equipment at the end of the lease. If you have a lease that says, hey, you can borrow this equipment and it's $400,000 a year, and at the end of year 5, we'll sell it to you for $1. Any type of bargain purchase agreement pretty much kicks it out of being a true lease. If it turns out at the end of year 5, when you actually reach that point in time, if you decide, hey, I'll just buy it from you, what's the value, you can do that. That's okay. But if you agree upon a bargain price at the beginning of the contract, it's going to be called a capital lease, and it's different. That's more like an installment loan. So we're going to show you what a true lease is, what renting is like. This is very simple as far as the spreadsheet goes. You got savings coming in here. You're making $1 million every year. Your payments are $400,000 a year. It's just straight. What's kind of neat is these are your lease payments. Your entire payments are tax deductible, which is unlike the loan and the bond, where only your interest column is tax deductible. You have no depreciation, though. See, at least you don't own the asset, so you don't get to depreciate it. So your savings, you get 0 in depreciation. You minus the $400,000, and basically your taxable income is 6. You're gonna, that's a bigger taxable income because you don't have depreciation. You've got your tax, and so your after-tax cash flow is very healthy, very positive. And that's one of the reasons why leases are very popular, but you don't get depreciation and you can't have any interest deduction as well. So this is a very simple one. This is kind of a tax cash flow to show you what that looks like. It's probably the simplest of all the arrangements, and this could be a true lease or an operating lease. Now, let's talk about a capital lease. This is a place where, really it comes across like an installment loan, but we call it a capital lease. This is where you agree to lease the equipment for time. It could be like a lease to buy arrangement where you're going to lease it for equipment for a certain period of time, and then you agree at the end you have the option to buy it at a bargain price. And if you have that kind of condition in your contract, this would be called a capital lease. And in this case, because the accounting rules, the way they're written, they say, okay, capital lease, you're going to treat it basically just like a loan. You're going to have this same kind of scenario going on where you're going to have principal and interest payments, and the interest payments are tax deductible. So just like a loan, we go through, we get so much savings, so much depreciation. We have interest and depreciation coming off of taxable income, and the cash flow will be very similar to a loan. Very subtle differences, and in fact, many people call a capital lease an installment loan. So that's just one of the subtleties about the difference in leasing. Now, performance contracting, again, this can involve any one of these. Performance contracts are typically done on bonds because most performance contracts are done in the government. But they can be working with, capital leases, frequently true leases, all kinds of different ones. The performance aspect of it is not necessarily the financing piece. The performance aspect is the contracting piece. It's delivering a performance of operation or deliverable that extends beyond the construction period. And so those are probably the primary differences of PC. Generally, a definition, I'm going to just grab a drink of water while you read this. Excuse me. Okay, so generally a definition of a performance contract involves this very simple diagram. And I'm going to start off with something that's very simple and tell you how it's evolved. But typically the idea is that your utility bill is X dollars before the performance contract comes along. This could be a solar performance contract, could be a building, energy efficiency, lighting, air conditioning, et cetera, et cetera. But you're spending so much money before on this, operating this equipment. And you don't have any real capital to get something done, so you have these performance contractors come in. They basically are going to do something to your facility, install new lights, new air conditioning, change the chillers, whatever, put in solar panels, and basically your utility bill is going to go down. Now, they're going to want to get paid, right? And so part of that savings is going to go immediately to pay for the contractor, and the owner is going to get to keep some of the savings. So essentially, the owner is going to pay the same amount, but they're going to get new equipment that's going to reduce their bill, and some of that reduction is going to be used to pay the contractor. Now, the contractor could be paid with the payment could be coming from the finance people, if it's a loan or bond or whatever. The contractor could have his payments, as part of the installation, and now when we're saying you're paying back the contractor, you're really paying back the bank, whatever. It doesn't really matter. Someone's getting paid. Eventually, that money goes into the contractor, and you're paying that back either to the contractor or paying back the bank, one way or another. It's kind of taking away some of the savings you've made through this project. But without the contractor and without the financing, you wouldn't be able to get this anyway. So you have this improvement, but some of your savings is eaten up by the payments, and then after a certain period of time, maybe 5, 10 years down the road, you eventually get to keep all of the savings once the contractor is completely paid off. Now, this is classic, what we would call shared savings type project, and that's really how performance contracts started is someone would come into your facility and say, look, I'll save you 50% or whatever, some number, or I'll save you 20%. Let's split the savings where I'll get paid for my investment in your facility, and I'm taking all the risk here. If you don't save anything, you don't pay me. But if you save 20%, I'd like to keep 10 for myself, And the upside to you is, Mr. Facility, you don't have to do anything, and you're going to save 10%. And if you don't, if I just walk away and you don't do anything, you're still wasting money. So you could be getting 10% better, and over time that'll turn into 20%, et cetera, et cetera, et cetera. That would be shared savings. Now, those types of contracts aren't as popular anymore because it puts you, when I talk about, it puts the performance contractor in an adversarial position with the user, because let's say you do 20 projects and say one of them is performance contract on the air conditioning, and you go do that, and the guy guarantees he's going to save you 30%, and you install this stuff, and you're saving 30%. But let's say independently of that, you do a couple lighting retrofits that also save money. How are you going to divide up the utility bill to figure out who saved what, which contract saved? It's very complicated, metering and M&V wise, measurement verification wise. So that would put the contractor every month saying, hey, we saved you X percent and we saved more, so we want some of that savings. And then you're saying, no, because we got that extra savings from the lighting project. So that's why shared savings has some major issues. And you can talk to me or you can talk to someone else about trying to optimize a contract for shared savings, because it's very complicated, and without the metering it gets to be kind of a mess. Another way to go with performance contracting is something called guaranteed savings. In this case, what the contractor does is says, look, I'm putting in the air conditioning equipment. I'm going to guarantee you're going to save 10%. If you save more than that, we're not going to share it. You're just going to keep it. But I'm guaranteeing that my part of the project is going to deliver X percent of savings or X percent of avoided costs or whatever the situation is. And then beyond that, you get to keep all the savings. So if you do lighting projects and you go do whatever else, you change the filters more often and change the motors, you get to keep all those savings anyway. I'm just working on the guarantee on my piece of it. And so that's a better way to go. That way, it's very easy to measure, hey, are we getting the savings on the system, yes or no? If we are, great. If we're getting more than that, even if the contractor says he's going to save 20 or 30% in air conditioning, and let's say he ends up saving 50, he doesn't get any more. He just gets his payment, and he gets paid for the work that he did, which is great, and he can go on to the next customer, and you get to keep all that extra savings. So there's some advantages to that too, which are somewhat attractive, and that's called guaranteed savings. And finally, there's another one called chauffage. I don't know if we have. Oh yeah, we're talking about all these ones. Chauffage, or I don't know how to pronounce it, is another way to say, hey, instead of me getting involved with installing air conditioning lighting systems, it's more like a leased building. We're saying we're going to provide Class A office space, and you're going to get lighting at 30-foot candles at the desk and 50-foot candles on a desk that needs that kind of light. And you're going to get 20-foot candles in the hallway, and you're going to get 72 degrees, between 72 and 74 degrees year-round. And we're going to deliver all of this for less than what you're paying now. That would be like a service arrangement or chauffage, where you're not really caring about the technology or whether it's saving or not. You just know your overall costs are low, and you're getting a service for that. And so there's lots of ways to do performance contracting, and then you've got solar performance contracting, which is PPAs, et cetera, which usually fall more into the guaranteed type savings arrangement. And usually the guarantee is basically this. We guarantee the savings on a solar project is going to be greater than the finance payment you've got to pay to someone to pay for the solar panels that were installed. So that's kind of the basic idea of these different structures. As I said before, PC can involve loans, bonds, hybrids. It can involve just about anything with your creativity. You can go there. And the contract is critical. How you get the contract, I mean, you can have it an open book contract where they're telling you how much they're spending and where they have, performance contracts typically, it's not one entity. They might not physically do all the work themselves. They might hire a lighting contractor, hire an HVAC people, a test and balancing person, a chiller person. They might buy equipment from chillers, chiller manufacturers direct, and have different people install it, and then they got to pay consultants to do all this estimating. And you may have a contract that says you're going to share all those costs and be very open about it. They may not want to do that. There's just a variety of different contracts out there. But shared savings, guaranteed savings, whatever. There's just a ton of different ways to do it. And there's no real way to generalize. different places do it well, and it just depends on, just knowing as a customer, you can finance it a lot of different ways and have a performance contract that is also structured a lot of different ways. Some of the benefits of performance contract, or really any financing thing, is that you get to use the new equipment without spending capital out of your cash reserves. In performance contracting, you're giving up a future of your some of your savings to get that equipment. In some government facilities, you may not have an option. If you don't have any money, you'll never get it done. You may, performance contract might be a great solution, or if you've got a situation where maybe you could pay for, you want to change the air handling units in one part of the building to give you better air comfort and make people happier and get less complaints, but the payback on it is 30 years. And through the process of bundling it with a lighting project that has a 2-year payback, maybe that brings that other project down to maybe 10 years, and then you can do the bundle and have a 10-year payback, and maybe bundle it with a couple other 2- and 3-year payback projects that bring it down to maybe 5 years, and then you've got something you can work with. So you can bundle things together to get things done that maybe you couldn't get done in the old scenario, and PC is a very big vehicle for that. Also, ESCOs want to work with bigger contracts anyway, so it works for them too. In some performance contracting, usually, if a company is going to guarantee that a chiller is going to save so much money based on a specific maintenance cycle and, maybe better maintenance and closer watching, they may require that they come out every quarter and do testing and make sure the chiller is operating at its peak performance and make adjustments to it. And I think that's right. They should, if they're going to guarantee it, they have to be in a position where they can control. They can't let, someone who doesn't know what they're doing with that chiller screw it up and script the performance of the aspect of the building, because that would make you waste a lot of money and on energy, and then they would be on the hook and they would be in control. So sometimes performance contracts might have, the performance contractor might have, hey, I need to be able to maintain that, I need to make adjustments to make sure that thing is operating at the most efficient way, and I want to have our service people do it, etc. One thing about PC that's kind of neat is theoretically it doesn't always happen, but by performance contracting, you get rid of the bidding process, you get rid of all this other stuff, and the owner can concentrate on building the widgets or doing what they do. Running an airport, for example, they don't have to get involved with spending time with, the endless process of consultants and then bidding and then, awarding the low bidder and then dealing with change orders. Performance contracts are usually like, hey, we're going to do it, and we might have change orders, if you want to do more, but we're going to guarantee this performance, and it's a little bit simpler from a purchasing standpoint. Okay, so this talks about performance contracts. Often the assets are turned over to the host at the end, so capital leases and bonds are typically very valuable and popular. Because performance contract people don't want to keep the stuff hanging around. So performance contract might be very, very simple. You have no money to invest. You can't get, maybe you can't get traditional financing or whatever. You save $1 million. You might spend $800,000 on your performance contract, and after a certain amount of time, maybe that goes away, and then you keep the rest of the money. But basically, this is one example, very similar to a true lease example, but it could be structured with a capital lease or any of the other arrangements we've mentioned. So that's kind of the basics on some of the basics, different arrangements that you're going to see out there in the energy management world. And what I'd like to do is open it up for Q&A, and I'm going to just leave it. Let me do this. If you have a question, go ahead and say, yes, I have a question, and I'll take any question you got. Once again, these are arrangements that you can involve with each other, et cetera. We're just trying to help you understand the different arrangements, what's really going to come down to is you're going to go out to your CFO, your finance person, whoever you typically work with. They probably have a vehicle or a lender they're used to working with, and that's most likely the way you're going to go. But if you can explore these other options with them, this might open up new doors. You might explore, hey, well, have we done a performance contract? Or, hey, have we done a capital lease on this? Or maybe we can make this go this way or use this other bank that energy projects, and they might be able to help us with this particular problem. So the creativity is up to you. You can take this as far as you want. But if you implement what I've talked about, the basic understanding of these different arrangements, it really gives you a lot of flexibility to get more projects done. And that's the whole reason why I'm doing this. I'm hoping you get more projects done. So I'm going to leave it open. Does anyone have any questions? I could bring out some of you just for audio purposes to say hi, which I might do because I always like talking to some of you guys. But if there's anyone who has, I'll unmute a few of you here, just top 3 people here that I can see. And I'll call you out. Charles Rampy, Donald Riley, Les Pace. Do you guys have any questions?
This is Charles. I don't have any questions. It's a good presentation. Are we going? Will these slides be available for download at a later time?
Absolutely. What we'll do is when we're done today, the recording will convert to a Windows media file, and we'll send that out to y'all. And then we'll also send a PDF of the slides, so you've got that. We always change the slides last minute, so I always send that afterwards because I want it to match up. But I'll send that out to you later today.
Okay, great.
Great to hear you, Charles. And we got Don O'Reilly says, you mentioned grant option for non-profitable situations. Can you describe more? Absolutely. Don, what you got a situation there is with the legislation, not the TARP legislation, I think it's called the clean energy, I forget the number. There's two bills out there. One of them basically enabled, it's primarily for renewable energy. If you put in wind power, solar panels, geothermal, other type of renewable energy, you can get a 30% tax credit back from the government. And that can really help you, and especially, I believe you're in Texas, so you can get that tax credit. You probably can get a tax credit or some type of credit from the utility, like Texas Utilities Encore Electric, the regional distribution company, will even give rebates. I know for solar they'll do 25%. So really, like 55% of your project could be paid for with other people's money. And in the case where if you're not profitable, you can definitely get that tax credit as in the way of a grant, and there's a process to go through that on the website. You can look up, Google that, tax grants for energy renewable projects under new legislation, and I bet you'll find something. And there's a process to get that money. I haven't personally done it, but I know clients that have, and they've been able to get a grant in place of a tax credit to help them fund a project. I don't know if the local utility is doing that. I mean, essentially they're not giving you a tax credit, they're giving you cash. So that wouldn't be an issue for them. But from the federal perspective side, you can get grant in place of tax credit. Does that answer your question, Don? And Don, I can see you're on a microphone, so we cannot hear you unless you've got a microphone on your headset. But you can just text me if that's right. And so hopefully that helps you. If not, just text me again, and I'll give you more. Les Pace, have you got anything to say? Can we hear you? Let's see if we can hear you out there.
No, I appreciate you very much. It's a very good presentation.
Awesome. Well, it's great to hear you, Les, and Don saying yes, Google fixes most things. I like that. But really, that's a good one. I should, really, this grant in place of tax credit is a pretty big piece. I'm trying to think of the exact website, but if you go to the Department of Energy, or you go to probably the White House or the Energy EPA, or I'm trying to think probably the IRS. The IRS would be another place to look. Or if you Google, grants instead of tax credits, you'll find something. It's a very, very well written option, and people are taking advantage of it. So hopefully that helps you out. All of you, it's been great to have you. The rest of you that are on the call, we really enjoy having you, and I hope everyone has a wonderful Christmas. Does anyone have any last-minute questions before we sign off today?
Eric, I might add something.
Yeah.
Right in the very beginning, we talked about make sure maintenance people are trained into the new technology, whatever's being installed. We also need to talk to the purchasing agents that say, like in a lighting retrofit, if you put a certain particular type of lamp in, that the purchasing agent knows that this is taking place out there in the plant or district or wherever. And from now on, they need to order that type of lamp for a replacement rather than the one they have been ordering.
Well, that's a great point.
You keep the integrity of the entire project intact.
Yeah, that's a great point. I mean, under maintenance, a project is only as good as the least common denominator with maintenance, and the weakest link, as they would say. And I agree with you 100%. It makes no sense if you put in a project and then purchasing continues to buy lamps for the old one. The maintenance guys might just stick in the old lamps instead of the new technology. So that's a great point. And sometimes with performance contracts, you might have to, or any kind of project, you may have to implement new maintenance procedures that handle the operations. And performance contract, one thing about performance contract, I mean, contracts can be complicated, but that's one good thing, because performance contractors already kind of walk this road with chiller maintenance and some of the other things I had said, that if they're going to maintain the guarantee on it, they have to be able to make sure it's going to operate right. And part of that, because of failures, they've learned that they need to have the maintenance processes updated and in line with the new technology they're putting in. So sometimes looking at a performance contract language and looking at the operational maintenance requirements that they ask for is a good place to look where you might have to make some changes if you're doing it yourself. And that's a great point, Les. That's perfect. So anyway, great to have you guys. I wish you all the merriest of Christmases. Notice we've got the updated schedule. It's like Profitable Green Solutions /schedules 2. That's just for you guys. You guys, as you know, get a much better deal as members than anyone else. So enjoy that and have a great Christmas and or Happy Hanukkah, whatever you celebrate. Happy holidays in general. And I will be with you guys next year with some more webinars. And again, great having you, and you guys have a great day. This is the end of the webinar. Take care.
Merry Christmas.